am in for more self-employed borrowers. Today I wanted to explain how banks calculate income for self-employed borrowers. We know that tax season is around the corner, so we wanted you guys to be informed and to be prepared because this is your year to purchase your home. Okay, so I used a sample of gross $200,000 income. Gross means that's before any expenses that you have to conduct your business. Okay. Now, by self-employed borrowers, I mean borrowers that are 1099 that receive cash, like sales, different forms of payment, but it's cash, and also company owners, LLC owners. Okay. So the first example I used is a sales price of 700,000. Okay. Now you have 20% expense ratio. That means that your net income is going to be $160,000 a year. Okay. That we divide by 12 and we get a monthly income. Okay. That monthly income, we use only 50%. Okay, because the other 50% you need to have available for utilities, living expenses, and other expenses that you may have. So the banks are only going to use 50% of your monthly, which from there, we're going to take any monthly liabilities that you have reporting on your credit. If you have child support, we will also have child support taken out of there as part of your monthly liability, the same as alimony, and other things that you have, responsibility to pay monthly besides your living expenses. Okay. So I did an example of, let's say, if you had an IRS debt of 200, okay, a car debt of 800 monthly, and credit card 600. This is just an example because obviously everybody has different, liabilities on their credit, but I just wanted to give you guys an idea. Okay. So we would take the 6,600, which is 50% of your monthly income, and then we would subtract your monthly liabilities, which I added those, and it's $1,600. Okay, so you would have leftover for mortgage, which is principal, interest, taxes, and insurance. And if you have association, we would have to add the association monthly fee and flood insurance if you're in a flood zone. So that would have to be for the whole mortgage payment. Okay, so that would be more or less for like 670,000 to 675,000 loan amount. Okay, this is based on, again, an idea of a $700,000 dollar purchase price and with a minimum down payment. Okay, down payments also affect the monthly mortgage and taxes. Like I said, insurances, all that, those things can vary. But I just wanted you guys to have like an example of different scenarios. Okay, so that's one scenario. Let's say that your expense ratio is 30%. Okay, not 20%. So that would put you at about 140,000 net. Okay, a year, based on the gross that we're talking about of 200,000. Okay, that would give you $140,000 of net income a year. The monthly on that would be about 11,600. Okay, that I'm going to use half. Remember, because we need the other half for living expenses, etc. So that's half, and then we would apply the same monthly liability that we have. Okay, so that would give you about 4,200 for a mortgage. So that's more or less a loan amount of 530 to 550. Okay, again, we are basing it on more or less a $550,000 purchase price. What could vary is property taxes, as I have explained before, insurances, etc. So this is more or less like an idea. Okay, because also, I mean, you can buy property, for example, that right now the sellers have been living in it for a long time and the property taxes are a bit on the low end. And we will use, for the most part, the current tax bill to calculate, based on calculating your monthly payment. However, the taxes are also based on, the property taxes are also based on purchase price. So, the next maybe tax bill, your monthly payment could change because the property taxes could also change. Okay, so we can talk about more about that in another video. All right, so now the third scenario is a $400,000 sales price. I'm gonna stand over here because over here is better. All right, and we did 40% expense ratio on this one. All right, so then you have $120,000 a year of income, net income. We have $10,000 a month when we divide it by 12. That gives us about $5,000 a month of income that we can use. Okay, and then we take again the liabilities, and then we have $3,400 for a mortgage, which would be about, a price of $380 to $385 loan amount. Again, based on taxes, insurance, etc. Okay, so that is how we more or less calculate the self-employment income. Now, there's also some other details, like for example, let's say that your car loan is being paid by your company because you're using your car for business. Then we would be able to omit that car payment from the liabilities, giving you more income for your mortgage, but we would have to have 12 consecutive months being paid by the company on time. And the car would have to, the expenses for the car would have to reflect on your yearly taxes, whether the accountant, you're going to depreciate it. I mean, however your accountant is going to do it, it has to reflect that you have that car expense. The same thing for your credit cards. If one of your credit cards or two of your credit cards, you use it to purchase items for your business, then if the business has been paying it for the last 12 months, we can also, in some cases, in some programs, okay, loan programs, omit those, but they also have to be paid 12 months consecutively by the company, and we have to see them as an expense on the taxes. Okay, so this is how we would now. Any questions you have, you can reach out to us, and we can clarify some things. But I just wanted you guys to prepare, because preparation is key. If this is your year that you're intending to purchase your property, I wanted to help you and direct you more or less on how we calculate income, because a lot of self-employed borrowers would come and say, "Hey, I made $500,000 or $1 million," but we go to the net, because we cannot consider gross income, because you're using part of that to, you have expenses on that to basically operate your business. So we can't, use the gross income. Now, we do have other programs for self-employed where we would use bank statements, not necessarily taxes, but we still have to apply an expense ratio. Okay, even on your deposits monthly into your business bank statements. But I hope that this was helpful for self-employed borrowers to get an idea of more or less what your purchasing power is. Now, you can also call us, but we know that this is your year because you were meant for more. Call us, we'll help you.